We have a quorum. I call the meeting to order. First, we want to follow up on the matters raised at the meeting on the 15th of June. The matters arising from that meeting have already been addressed by the government in a written reply in paper CB-1679/2026-02. The administration addressed the questions. I do not propose to ask the administration to go through the reply again. If members have questions about the reply, you may raise those questions now. If there are no questions about the reply, let's proceed with the meeting. First, the submissions. On LegCo's website, the Secretariat has put out a notice inviting public submissions. The deadline for providing submissions is Monday, the 22nd of June, 5 p.m. The government will provide a consolidated reply to the submissions received. Now let's resume the clause-by-clause scrutiny. Before we start, I want to draw members' attention to something. We had a thorough discussion of the policy aspect of the subsidiary legislation. The three pieces of subsidiary legislation involve a lot of professional jargon. The provisions were arrived at after calculations done by professionals, and they're in line with the long-established practice of the industry. So I hope for today we can focus on the accuracy and any omission in the legal provisions, and we can focus on the clarity so that we can proceed with the scrutiny with efficiency. We now resume the clause-by-clause scrutiny. So this is the Insurance Valuation and Capital Amendment Rules 2026. Members can refer to the Chinese copy of the markup copy CB-1627/2026-02. We will start on page 23. Will the administration take us through each clause? Members can refer to page 23 of the marked up copy up to page 25. We're looking at LN 58, Clause 8. And that's on page 12 of LN 58. So Clause 8 amends Cap 48R, Rule 64. Under general insurance business, the reserve risk factor is lowered from 55% to 30% for pecuniary loss, credit, and other. Please proceed. Clause 9. Members can refer to the marked up copy, page 27 onwards. Clause 9 amends Cap 41R. That's Rule 48. This is for the risk capital amount for natural catastrophe risk factor based. Rule 9, bracket 1, and Rule 9, sub-Rule 2 are textual amendments. 9.3, 9.4, and 9.5. Insert a new paragraph under Section 68, Rule 68, bracket 2. That's 3B and BA, amending 68.2, allowing insurers to apply 65% of the net loss in place of 100%, which is the current level. Because of this change, we have to amend 68.2b, meaning we have to amend the formula and the parameters. 69.6. Members can refer to page 28 and 29 of the marked up copy. This amends 68.4 and inserting 68.4a, 4b, and 4c. The change will allow the insurer to estimate the gross value of the once in 200-year catastrophe. B sets out the criteria insurers have to meet. For C, sets out the IA's power to oppose such decisions, and it's about serving the written notice. 9.7 and 9.8, 9.9. Members can refer to page 30, 31, and 32. This amends 68.6, 68.7. This is about the risk factors for natural catastrophes. We're lowering the eligible infrastructure investment and also various factors for the proportional business. The IA has reviewed this aspect and decided to lower certain risk factors. 9.10, 9.11, 9.12, 9.13, 9.14. These changes are consequential textual amendments. Members can refer to pages 35 and 36 of the Chinese marked up copy. 9.15. Members can refer to the Chinese marked up copy, page 36. This is for 41R 68.9. We're inserting item C. This is for the counterparty default risk. This is a change in response to the 68%. There's a question from members. First, Ms. Carmen Khan. As the chairman said, many formulae and professional jargon from the industry are involved in this amendment exercise. We will need the comment from the industry on the revisions. I want to backtrack. We don't have to go back to the provisions. I want to go back to page 29 of the marked up copy. If the IA thinks the insurer fails to give enough justifications, what's the normal practice? So do you oppose that? Does the IA state the grounds? Does the IA get in touch with the insurer? How does the procedure work? Can you tell us about that? The IA will take us through the procedure. We look at the financial statements. In some cases, we may think the formula does not apply. We then hold a meeting, or we can talk to the insurer face to face, and then we tell them why we think that formula does not apply. So we hold meetings, or we can issue letters to them. Chairman, one comment. What's the position of the IA? Here it says the risk factor. You approach the matter from a matter of risk. You assess whether that's good enough, but on what grounds do you reject the insurer's position? The IA? Mr. Wen? The actuary? We look at the data and we ask the insurer for evidence. We will issue guidelines stating clearly what we look for. We refer to other parts of the ordinance. There are provisions allowing insurers to adopt their own catastrophe model. So we refer to those provisions and apply the same standard. The IA, once spotting abnormal data, will talk to the insurer because each side has a different model, so they get into a discussion to sort out the difference. So there is a dialogue, there will be negotiations to work out the difference. So that's the usual practice. Mr. Holden Chow. Thank you. I was going to ask the same question. Page 29, 4A to 4C. Ms. Carmen Khan raised the question. It's a question of the grounds. The industry is familiar with the formulae involved. Based on the text, for me, it seems that when the IA object, as the chairman said, there will be negotiations. So do they make changes after the objection and then comes back to the IA for approval again? Here, the text says objection, and that's it. So will there be a chance for the insurer to amend their model and then submit the matter to the IA for approval again? If we think this provision does not apply, we will talk to the insurer. We may follow the practice under the old provision. So we're talking about a 1 in 200 year catastrophe. Each insurer has its own model. The IA also has guidelines. So there will be differences in the results, and when there is a difference, both sides talk to each other to work out the difference. So this is a day-to-day operational matter. Each insurer handles such matters. Ms. Christine Fong. I want to write on Ms. Carmen Khan's question. 4B. It says, the insurer's estimated gross 1 in 200 year annual aggregate loss for the peril region over the 12 months immediately after the valuation date. And then you have items A to D. If this insurer fails to submit the documents, the insurer does not get the concessions under the new rules. Is there a time limit on when the insurer has to submit the documents? If the insurer fails to meet the requirement and then the matter falls by the wayside, there is no penalty, no fine. So how would that end? A brief reply would do. So we're talking about a 1 in 200 year catastrophe. We allow insurers to apply their own internal risk models. If we see something wrong with their own model, there's a standard factor for catastrophe risks. Now my colleague can tell us more. For A to C apply to exceptional cases. So those are the fine detail. We do not expect that these three provisions will be engaged all at the time. Ms. Carmen Khan. I have a question about Table 11 on page 31. Why take out Taiwan? And what about the Chinese terminology for Chinese mainland? What should we make of the revision here? Thank you. On page 31 on the left, we're taking out the entire table. We're not just removing Taiwan. So you're removing the entire table. In its stead, we insert a new table. So we're making a change to the Chinese name for Chinese mainland. So we apply the new terminology across the board. So are you making the change across the board? Please proceed. 9:15. This is page 36 of the marked up copy. This is for the risk amount for counterpart default risks. It used to be 100%, now we put in 65%. So that's for the calculation of the risk factor. Clause 10. Members can refer to page 37 of the marked up copy. This amends Rule 69 of 41R. This is for the risk capital amount for man-made non-systemic catastrophe risk. We're changing the risk factors. We're inserting a new formula. 10.1, 10.2, 10.3, 10.4. These are consequential textual amendments. Ms. Christine Fong.
Well, my response might be somewhat slow. Well, on table 2, Ms. Khan was asking about this, that is, you deleted Taiwan. I thought that you deleted Taiwan instead of the entire table. So I suggest that you should cross out the entire table so the public would understand, so that they know that this is an altogether new table. Okay, please proceed. Thank you. Next is 10.5. You can refer to page 38 of the marked up copy. Well, that's under cap 41, and subparagraph D has been added. That's about the non-human, that is explosion and also major fire. That's the calculation formula. And then 10.6 and also 10.8. That's on section 69. And there are textual amendments. And 10 is about man-made catastrophe, for example, big fire, and then about ship loss or vessel loss, and then aircraft loss, and then the default by the major or attributable to the major respondent or person responsible. So you can also make reference to page 39 under cap 4169. There is a new paragraph, and also for the second scenario about vessel loss, there is a new calculation formula. And then 10 bracket 12, there are also textual amendments. And then 10.13, that's on the third major scenario. That's about aircraft. The factor has been adjusted by inserting a new formula. Yes, Holden Chow. Thank you, Chairman. Page 37. Well, I have some questions. I can see that for the major capital, that has been crossed out and replaced by the point about the major person responsible. So we only need to change the Chinese text. So that's the large principle in English. So a better translation in Chinese is to make sure that the person who has to make the repayment will be the large principle. So the debtee who has to repay would be exposed to major risk, and if there is any default on his part, a factor will have to be inserted. Okay, thank you. Please go ahead. Please move on. Yes, Christine Fong. Thank you, Chairman. Well, I'm a layman. So on 69, subparagraph 1, is about works and also explosion. Well, you might have some precedents because worldwide there must have been some cases. So in the future, will you be giving us some examples of previous cases so that I can also be included as guidelines, and we can also be given some references? Yes, I think there have been established procedures and definitions in undertaking this. I think insurers and the IA know that very well, and therefore there might not be any need for such guidelines and so on. So IA, do you agree? Chairman, let me put it this way. With regard to that amendment, that's about risk factors, and there have been some adjustments with regard to the four scenarios: explosion, conflagration of property and engineering, and loss of marine vessel, and so on and so forth. Those would not be changed, and therefore the policyholders' responsibilities and relationship with them would not be changed. Next, 11 and 12, you can refer to pages 45 and 47. Well, 11 is to amend 77 and 78 with regard to onshore standard mortgage insurance. The reserve risk factor would be changed from 55 to 30. And then clause 13, that's on page 49. So that's to change sections part 7. So insurer, if they are qualified, then they can also be included under the mechanism to calculate the capital amount. Well, at the meeting on Monday, that's LN 58. Clause 7. For insurers that are qualified after approval by the IA, there is no need for them to reserve extra capital amounts for the purposes. Yes, while you are explaining to us, we can see that you have lowered the percentage from 55 to 30. So can you, while you're explaining, can you connect us to the policy rationale behind this and why you have decided to lower the risk factor so that we find it easier to understand? For example, on page 45, you said that you have lowered the risk factor from 55% to 30%. Well, because earlier on when we discussed that policy, we have been able to achieve the objective, and therefore we have decided to lower that. I think we discussed that when we discussed the policy. So if they can also relate this to the policy intention, then that would be easier to understand. Okay, so can you clarify that where possible? Yes, please move on. Clause 14. You can refer to page 54 of the marked up copy. 14.1 is to amend table 2. That's a correlation matrix of prescribed capital amount, and table 2 can be found on the left hand side of page 54. So that has been crossed out, and we will be inserting a new table 2. You can see that you have the 25%, and we have half that to 12.5%. So that's the correlation matrix for prescribed capital amount and also risk. And then 14.2, they will be amending table 6 about general insurance other than mortgage insurance risks and also the sub-risks. You can make reference to page 55, table 6. There has been an amendment, so it's been lowered from 25% to 12.5%. And then 14.3, amendment of table 7. So that's the correlation matrix for reserve and premium risk that would be lowered from 50% to 25%. Let me briefly supplement the figures that you have seen with regard to the lowering of the reserve risk, because over the past few years we have got the data from the insurers, and we have also looked at international practices. So we have looked at actual data before we decided to lower them. And then 14.4, you can refer to page 56 and 57. On the left-hand side, table 10 has been crossed out and replaced by the new tables on the right-hand side. That's table 10. So that's the natural catastrophe risk, and then the sub-risks in different regions have been redefined or subdivided, and there has also been a lowering of the risk factor for Hong Kong and Chinese mainland. And then 14.5 is on page 58 and 59 of the marked up copy. So in accordance with table 10, corresponding amendments will be made, and table 10 is about windstorm, and then this is about earthquake. So for these regions, there would be further subdivision, and the risk would also be amended accordingly. Next, part 4. So that's relating to miscellaneous matters. So that's clauses 15 to 35. So amendments in relation to other matters, including cryptocurrency and also the matching business, and also anti-cyclical amendments and so on. So we move on to 15, clause 15. You can refer to page 60. 15 is about the interpretation clause, including crypto assets, intangible assets, right of use assets, and so on. Well, in scattered locations of CAP 41. They have been concentrated here, and corresponding amendments have been made. Next, 16. Yes, Ms. Khan. Carmen Khan. Yes, can you tell us more about the definitions or interpretations, for example, on crypto assets? What have you referred to before making this definition? Well, in the first reading, we talk about virtual assets. So there has been a report. There will be a reporting framework, and there are also definitions about crypto assets. So how does this crypto assets definition come about? Yes, thank you, Ms. Carmen Khan. For crypto assets, that's from the existing Section 8 on unlimited Tier 1 capital instruments. So that comes from the existing provision, and we have now put it in the relevant paragraph in the amended version, so that for all the definitions under the existing CAP 41, they have been put in here. And that's because of the development of the industry, and also the government has already passed the legislation on stablecoin, and therefore crypto assets would not include stablecoin. With regard to the definition of stablecoin, we will also be dealing with that later. And what about tokenized traditional assets? Where does it come about? Well, for tokenized traditional assets, that's a newly added definition. Well, for tokenized traditional assets, we have made reference to CAP 155L. So that's about the capital of banks, because that's already been a definition for tokenized assets. So can you explain to us? So what does that mean? So it means assets that use cryptography and crypto. So it's not just about cryptocurrency, it's about something else as well. So can we ask the colleague from the IA to explain that? Thank you, Ms. Khan, for your questions. Well, as explained, we have already got a definition on crypto assets, but then the two purposes of the amendment is that, well, for specified stable coin, that would be excluded from crypto assets, and also for tokenized assets, for example, government bonds, so they would be tokenized assets. So the purpose of the amendment is to separate the two types of assets, because we'll be able to see the underlying assets, and then we can do evaluation accordingly. Well, in simple terms, for crypto assets, that would not include a value to be given. But then we'll be looking at the underlying assets to see what the assets are actually are, and then we will be able to calculate the risks accordingly. Yes, for capital requirement, you will be looking at different types of assets, and then the factors will be different. So that's an amendment in line with the developments. Yes. Well, there is a perspective that I'd like to clarify. I can see that for the definition of crypto assets, you've actually done it by way of exclusion. For example, you have excluded, well, if it's not a specified stablecoin, because we already understand that we have our own stablecoin ordinance, and also you have also excluded things that have not been issued by the central banks. So that's what we call CBDC, that is cryptocurrency issued by central banks. Because my understanding is that, well, when you explained the policy last time, you made it very clear that is for cryptocurrency in general. Well, there might be different risks entailed. Well, but then you try to do it by way of a conservative and prudent approach. But then for specify stable coins. For example, last year, the SAR government also specified or designated 2 banks that they could issue stable coins, or the CBDC, the central bank's digital currencies that I refer to. They are relatively stable and trustworthy. But then for other crypto assets, you'd rather err on the safe side, and therefore you try to highlight them here, and by way of exclusion, you try to set up what is meant here. So I just like to find out if my understanding is correct. Yes, Mr. Holden Chow, your understanding is correct. That is stable coin and also other capital that would be more manageable in terms of risk would be excluded.
Dr. Johnny Ng. For funds listed on conventional exchanges, there are products tracking the prices of crypto assets. Are such assets defined here? For the IA, the IA will take the question. Dr. Ng is referring to the recognized crypto asset funds. It depends. A policyholder may buy insurance-linked securities and they choose to invest in crypto assets. For the insurer will be allowed to calculate the market price of such assets. But if insurers themselves invest in such assets, we take the look-through approach. If there are crypto assets, we will disregard the value of such assets in valuation. Mr. Robert Lee. I want to find out more about the tokenization of conventional assets. What do we mean by conventional assets? I get it. By tokenized assets, we're talking about tokenized assets, fixed income as product. But my question is, do we have a line drawn between conventional versus tokenized or crypto assets? I need more elaboration on this. For the IA, when we say tokenized assets, we look at the underlying assets. We take the value of that underlying asset for our calculation. Now, on tokenization, if the underlying asset is a crypto asset, then there's no value. If the tokenization involves bonds, then we look at the market price of the bonds for calculation. But what do we mean by conventional assets? Here it says tokenized conventional assets. So are we saying we factor in deposits? But what about fixed income assets? And where do we draw the line? We adopt the definition of the banking rules. We align our definition with the rules. So can you elaborate by illustrating with examples? So what assets are included? I don't need an exhaustive list. I just need more detail on what we mean by traditional assets. We can provide a written explanation after the meeting. This is a broader question, so maybe a written reply after the meeting would do. Ms. Carmen Khan. I thank Mr. Robert Lee for raising this question. We need more clarity on what is meant by traditional assets. Are there requirements down the road? You have to, because here it says, where all rights, obligations, and interests arising from the arrangement are clearly defined and legally enforceable in all relevant jurisdictions. That's what we mean by traditional assets. Deposits, for example, we all get it. We know what the rights and obligations are. That's clear across jurisdictions. You can tokenize deposits or bonds. We all know the rights and obligations. Do we take only those as traditional assets? Is that how we should read it? That's correct. Thank you. If there are no other questions, we can move on. Clause 16, members can refer to page 64 of the marked up copy and page 65. This repeals the definition of crypto assets. We're moving that to Rule 2 interpretation, where crypto assets are defined. And we're removing this from the deduction item, so that's 65 to, we can look at page 65, paragraph O. 8.3, paragraph O is deleted here. Subsequent provisions will refer to what we do with crypto assets, so there's no need to make the deduction here. Clause 17, members can refer to page 68. Clause 17, update Rule 65 so that the reserve, unit reserve, can apply to certain products. It does not apply to index-linked universal insurance. Clause 18. Members can refer to page 69 of the marked up copy. Under 41R, there's a reference to counterparty default and other risk. We will take that out and create a new category of other risk. 37(1)(c), there's a calculation of the capital amount. Members can refer to marked up copy page 69. 18 bracket 1 bracket 2 bracket 3 bracket 4. These provisions have to do with changes to the counterparty default and other risk. So now this will read counterparty default risk instead. Other risks will be covered elsewhere. Clause 19, 20, 21. Members can refer to the marked up copy, page 72. This amends Rule 41 under Cap 41R. We took out the other risk from counterparty and other risk. That's why we make this change to Rule 41. The legal advisor has something to say about Rule 37. I want to let members know that the administration just walked us through Rule 37. We can refer to pages 16 to 22 of the marked up copy. They amended Clause 22. We prepared the marked up copy based on the changes in LN 58. Here does not reflect the changes from 16 to 22. There was a amendment to 37 under Cap 41R. Thank you. Clause 20. Members can refer to page 75. Just like the change to 19. For 41R under Rule 42, it's a textual amendment. Clause 21. Members can refer to page 78 of the marked up copy. Just like 19 and 20, we are making it clear that what read Rule 37.1 should now read Rule 37.1a instead. It's a textual amendment. Clause 22, members can refer to page 82 of the marked up copy. Clause 22. This is for a change to the counter-cyclical adjustment. The IA can adjust the upper and lower limits of the counter-cyclical adjustment by way of a Gazette notice. And this is also a change to the reference to Rule 49 of Cap 41R. And we're only setting out the changes to 22 on pages 82 and 83. For changes to Rule 5, we covered that at the last meeting. So for Clause 22, we're simply making changes to the reference to the upper and lower limit. Mr. Holden Chow. I have a question about the language. Page 82. Developed market listed equities, emerging market listed equities, portfolio investments of no look-through and other equities. We are taking out the text and we replace that with those types of equities. My question is this. When we say those types of equities, are we saying this new text already covers the text we are taking out? We don't get to see the entire legislation. I just want to check my understanding. We want to avoid repetition. Members can refer to page 82, 49 to a. There's a text reading developed market listed equities, emerging market listed equities, portfolio investments of no look-through and other equities. That reference is already found in 2A. 2A2 refers to the same kinds of equity, so we see no need to repeat the text. That's why we propose this textual amendment. It has no effect on the legislative effect. 23, 24, and 25, 26. For the marked up copy, you can refer to page 85. And this is for Rule 41R, 80, 89, 75, 79. Again, these are textual changes. Counterparty default and other risks, we're replacing it with counterparty default risk. This is in line with the change to Rule 18. We're updating the terminology, so it's just counterparty default risk. Members can also note that 89, 68, and 69 were making changes. The changes were covered under the discussion for Rule 9 and 10. That's why in the marked up copy you only see 23 and 24 for Rules 80, 68, and 69. Rules 27 and 28. Members can refer to page 104. Rule 27. This is for Division 5. Again, this is updating the reference to the counterparty default risk and other risk. 28.1 to 28.14. This is a change to Rule 81 of 41R. Members can refer to the subsequent part. We are on page 104 onwards. Indeed, page 104. Most of the changes under Rule 28 are found on pages 104, 105, and 107, and also 109. Rule 28 amends Rule 81. This is for the counterparty default risk for stable coins. Right of use assets and cash items, their definition is removed here and moved under Rule 2 of 41R under the interpretation where we'll have an overall definition. Rule 29 and 30. Members can refer to page 111 and 113. Rule 29 and 23 have to do with Rule 83 and 85 of 41R textual amendment. Rule 31.
文本第113頁。
Page 113 and 114. That's to have a newly added 85 capital A, risk capital amount of other risk. As we just said, that's the other risk that has been separated from the counterparty risk. So that will set out what would be included here, including the calculation of capital risk capital amount, and also amendment to 86 and so on. So that would be calculated as part of the capital of the insurance, and also 100%. So for net asset calculation under stress, so that would be included in the part concerning the calculation of other risks, and also how to calculate the risk capital amount. Holden Chow. Thank you. I've been waiting for this part. I'd like to go back to the origin of this, because for the counterparty default risk, so that used to be defined as a counterparty risk in the past, and now you've enhanced it. So you're talking about a counterparty default risk, and then you would then separately have other risks, and that's been inserted as a new 85 capital. I've been waiting for this for a while. Well, please don't mind my elaborating on this. So you have now clarified the definition of other risk, and as to how we deal with crypto assets and so on. So these factors have now been incorporated. So I'd like to find out more. So for counterparty default risk, when compared to the other risks and also the risk capital amount for other risks, fundamentally, is there any difference? You know what I mean? Because initially, that's under the same umbrella. So you just have a parent company with all these covered. And I can see that there are some differences. And if you look at 85 capital A, it's been set out what the capital, what the risk capital account or amount would include. But then, how would that be dealt with? Can you briefly explain that to us? Thank you. Thank you, Chairman. Thank you, Mr. Holden Chow. Well, for counterparty default risk, well, we have taken out, we have taken part of it out and have this, and now have this new amendment, and we have this 100% downward stress to the value of such assets. And then for counterparty default risk, that's about specified stable coin, because there is a chance that we might not be able to honor the commitment. That is, we may not be able to make sure that they can repay the value for the stable coin, and that's the reason why we have incorporated this. For example, behind the stable coin, there might be some overseas governments' cash assets, but then the government might have gone bankrupt for whatever reason, and then for some reason they may not be able to repay for such stable coins, and there would be risk entailed. And therefore, insurers, if they hold such assets, they would also have to calculate the counterparty default risk. So that's the biggest difference. So please don't mind my asking further. I don't know if it's correct, so let's discuss it. Okay, when we talk about such risks, well, back to the basics. So these are assets held by the insurers. So that's the fundamentals. And now we do have some emerging new assets, for example, in stable coins and crypto assets. That's because that's the reason why we have to make these amendments. All right, you talk about the counterparty default risk. Okay, if the counterparty default, and then you will go after that party if they have cash, if they have stable coins, and then I would be going after that party for all these. But then what about other risks? Because by other risks, can we also have such components? For example, if the counterparty fails to discharge his duty, then when I go after him for repayment, so can I also incorporate all these in that calculation? Because for the counterparty default risk, obviously specified stablecoin would be included. But then when it comes to other risks, would you also incorporate specified stablecoins? Why can't they be aligned? So you understand what I mean? Yes, I think Mr. Holden Chow is talking about counterparty default risk. What's the distinction between that and this for other risks? Yes, let me briefly explain, and then I'll ask the IA to supplement. In fact, under Section 81 is about counterparty default risk. So that would apply to the insurers holding certain capital or assets. So that would already be covered by the counterparty default risk, then nothing will be changed. But then what other asset items would be limited by this? For example, banks, well, they have deposits and also some insurance premium that has not been paid, and also reinsurer premium items, and also for this is a newly added item. So there is nothing changed with regard to counterparty default risk, but then for the specified or newly added stable coins, we're just adding this. So for the counterparty default risk, those would be covered. And now the reason why we have to have this other risk, that's because we have crypto assets, and therefore under 85 capital A, we have this risk capital amount for other risks, and that's to set out how crypto assets will be calculated. And you can see for specified stable coin that would be covered under counterparty default risk, and then for crypto assets that would be covered by other risks. All right, then I fully understand. If that is the case, then I can even add this. Well, with my layman's understanding, okay, if you owe somebody some money, then I'd rather get cryptocurrency than going after you for cash. Because let me put it this way, for all the backup assets, as far as the insurer is concerned, the most important thing is security. And then Mr. Fan, I think you explained that very clearly, so I understand it now. So what I'd like to add is, my understanding is that if you go after people for some outstanding money, then of course the most secure way is to go after the banks for the deposit, or to go after them for cash. And then I can also get a specified stable coin that would be more secure. So is my understanding correct? So I think you explained it very clearly. I agree with your definition. Thank you. Okay, so you will have to show the risk. I think things have been set out very clearly. Okay, let's move on. Thank you, Chairman. 32, marked up copy, page 115. Clause 32. So that's about Rules 86 amended. That's about risk capital amount for operational risk. That would not cover the insurance liabilities, excluding the margin over current estimate, and also any unit-linked business. So that's because we have looked at the actual operation of the industry. We have also taken on board the industry's feedback. So because for unit-linked business, we have also got the IUL, Index Universal Life business. So we have introduced this amendment. So we will be talking about that further. That's about Index Universal Life business. Next, 33. That's page 119 on the marked up copy, and also page 120. So that's to amend Rule 87, some textual amendment, and that has to do with 37.1. So that would become 37.1 and 1A, B. And members might want to take note of Rule 3718 that has been amended earlier on. We also talk about 81.9, and then on page 119 and 120, that would only reflect what has been changed for Rule 37.1a. And then clause 34, that's on page 124 and 126. The amendment is for Schedule 5 and then 2.3, so that would be changed to unit-linked business, and the actual effect is that for IUL, index-linked interest, they would be using the matching formula approach, and also where sufficient information has been provided, so that would also enable them to use the matching adjustment formula. Page 125 and 126. Table 1 in the original schedule has been crossed out and replaced by a new Table 1, and that set out assets that can be used to support the liabilities that are subject to matching adjustment. 35. This is a technical amendment. You can make reference to page 128. So that's to amend Table 3. So we use China to replace China and Mongolia. So that's all with regard to the amendments. Yes, Carmen Khan, you have a question? Yes, the administration has been explaining to us some technical issues, for example, on the equity capital and also the risk capital. For example, equity, risk, and so on. There have been some amendments, and we can see that you have authorized the IA to look at the stress factor, and by way of Gazette, adjustments can be made. And just now, Mr. Holden Chow also asked that for other risks that would be taken out from the counterparty default risk. That's to reflect the fact that, for crypto assets, when compared to stable coins, the risk factor would be somewhat different. So can you clarify that the amendments have reflected what you said about the policy, objective, and also intention? So can you explain that a bit further? Yes. Yes, I can confirm that for these amendments, that's to reflect the outcome of the consultation with the trade and the public. And the IA would also like to introduce these amendments after reviewing the risk-based capital policy. So for emerging developments in the market, for example, crypto assets and also stable coins and so on, that would be incorporated so that for insurers holding such assets, they'll be able to catch up with time. And also the regulatory approach would also be adjusted accordingly. Thank you. Okay, if there are no further questions, then we have completed the second piece of subsidiary legislation's clause-by-clause examination. We will now move on to the third piece. That is about the insurance, the public disclosure rules. So can the administration move on to this part? This is a new piece of subsidiary legislation, and please refer to LN 58. So, 59. Yes, we're going to refer to LN 59. The insurance public disclosure rules. So that's to disclose the details of their operation, including the substance and also the timing and also the extent of such disclosure. Well, all authorized insurers would have to disclose two things. First, the audited financial statements and also the financial returns. And then they would also have to disclose audited financial returns. And on the 22nd of May 2026. That has already come into effect. We can now move on to the clause-by-clause examination. On the rules with regard to the terms, definition, and also there would be definitions. Second is about the application. So it applies to all insurers, but then there would be exceptions. Under insurance valuation and capital rules, all applicable insurers for which approval has been given, and also marine insurers, captive insurers, and also special purpose insurers, because for these four types of insurers, they have very little contact with the public, and therefore for these four types of insurers, they do not have to disclose such information to the public. Yes? Ms. Carmen Khan, I didn't expect you to jump all the way from the first clause, interpretation, and then second is about application. Well, what about the interpretation? Can you explain to us why have you adopted such interpretations? So does that reflect the policy intention that is So you talk about the first applicable financial year. So what does that mean? Yes, can you explain? Well, we can go back to LN 59, page 1. Well, under interpretation.
Now the interpretation. First, we define the terms in the rules. Take participating business as an example. This is already defined under Section 21B, Section 11 of the Ordinance. We put the definition under Cap 41R, so that the definition for participating business is aligned and clear under the subsidiary and principal legislation. Now, on eligible internet website, this means, as subsequent provisions will show, applicable insurers will have to disclose their disclosure statements and audited financial statements, and that warrants the need to define an eligible internet website, so the insurers cannot just put the information on any website. So here it says that the insurer has to put the information on their own website or on the website of the group company if this is approved by the insurance authority. So this means the branch can put the information on the website of the group company. Disclosure statement. This is a new term. This means a statement of disclosure prepared in accordance with Rule 5. We will go into greater detail when we come to Rule 5. Now, on disclosure transitional period, this is a transitional arrangement. This subsidiary legislation took effect on the date of a Gazette, but we want to give insurers a transitional period. Ms. Khan suggested setting out in a timeline when the financial statements and disclosure statements have to be submitted for different deadlines of submission of financial statements. So in the reply, we have set out when the insurers have to submit the statements based on the close of their financial year. So the first year will be for insurers whose financial year ends on the 31st of December 2025. The authorized or applicable insurer will have to disclose the information within 8 months. The first batch of disclosures will be on the 31st of August 2026, meaning 8 months starting from the 31st of December 2025. B and C set out other rules. Now, for those that do not start on the 31st of December 2025, we have also explained how the disclosure will work for other companies. Two definitions: group company, and when authorized insurer set up a branch office in Hong Kong, we have to define what a group company is, meaning any subsidiary and any other company or entity which is treated as part of the ultimate holding company's group according to the applicable accounting standards. This is to clarify rules. On applicable insurer means an authorized insurer or lawyers. So there are two kinds. As I said, applicable insurers cover both authorized insurers and lawyers, so they have to disclose audited statements. For authorized insurers, they also have to put out a disclosure statement. Lawyers are not authorized insurers, so they don't have to put up the disclosure statement. Mr. Holden Chow, question. On application, that is Rule 2, there are a few exclusions: marine insurers, captive insurers, and special purpose insurers. These insurers have limited contact with the public. I know more about marine insurers. So for captive insurers and special purpose insurers, what's the scope of these two kinds of insurers? Just for public information. A brief reply would do. Thank you. Captive insurers have business overseas. So that's for supply chain risks, transportation risks. A group operates across the globe. Different kinds of risks exist. So the group can set up a captive insurer as a subsidiary of that group in Hong Kong. That captive insurer only underwrites the risk of that group, so it does not take any outside business. That means the group will not have to take out an insurance policy from outside insurers. So that's for captive insurers. It only underwrites the risk of its own group, meaning this captive insurers does not sell any policy to the public. Now, special purpose insurers. We had an amendment exercise in 2021, and there was a regulatory regime for insurance-linked securities. Because of the ILS regime, special purpose insurers arise. Special purpose insurers issue insurance-linked securities, primarily catastrophe bonds. Please proceed. Now, application on page 2, we covered 4 kinds of insurers. Due to their limited contact with the public, we are exempting these 4 insurers. Rule 3, timing and manner of disclosure. For authorized insurers and lawyers, they have to disclose their audited financial statements. Authorized insurers also have to put up a disclosure statement. 3.2. Mr. Robert Lee, question. There are specific deadlines and format. Eligible internet website, keeping relevant information, covering the last 5 financial years. I want to find out more. Now, there are mergers and acquisitions in the industry. How do we regulate that? When there's a merger, 2 companies become one, or a company may be taken over and then some subsidiaries are retained. So will the requirement still apply about keeping the records? Is there flexibility? Say, for a certain place, when there's M&A, as long as the new company meets certain conditions, they comply with the rules. So I just want to dig deeper into how things work for mergers and acquisitions. So it's about the dates and how long they have to keep the financial statement. Correct. There is a specified format, timeline for the record keeping. During the merger and acquisition, the process may take years. So where do we draw the line? For two licensed insurers, they have to keep the record. In a merger, they use a particular website, maybe the group website. So each side has to keep their records for the specified time frame. So I would like explanation on this point. The IA will take the question. The disclosure requirement applies to authorized insurers. So we take each authorized insurer as a unit. When there is M&A, as long as the status of the authorized insurer remains unchanged, that insurer will have to comply with the rules. But if the M&A results in a different entity, that new company will have to stick to its own clock. If the authorized insurer still exists, they have to comply with the rules. So my understanding is that we have to wait till the M&A completes. At that point, the insurer is still licensed, so they have to keep the records. So any company that existed prior to the M&A no longer have to keep the records. Rule 3.2. The disclosure statements have to be in both Chinese and English and adopt the standard template specified by the authority. This will be provided by the IA on the website. This is for uniformity in presentation. 3.3. The information disclosed cannot be false or misleading. 3.4. Publication of the audited financial statements and disclosure statements subject to a deadline. In the transitional period, that will be 8 months of a financial year, and subsequently after the transitional period, it will be 6 months. The insurer can apply for an extension of the deadline by 3 months. 3.6. An applicable insurer must disclose the audited financial statement and disclosure statement on an eligible website, and they have to provide the link to the insurance authority. 3.7. The authorized insurer must keep a record of all disclosed statements, and upon public request, the insurers have to provide an electronic copy or physical copy for inspection. Mr. Andrew Van. The insurer has to submit the information by a deadline. If they miss the deadline, they have to provide grounds. If the IA rejects the grounds, can the insurer appeal? We have not set out grounds for appeal. What can the insurer do in that case? I really cannot submit the information. What do I do? There will be a penalty. If they can foresee they cannot submit the information on time, they should apply to the IA for the 3-month extension. If they fail to do that, or if they fail to meet the deadline, but in 3 months' time, they have to pay a fine of $200,000 and $1,000 for every day over the deadline. 3.8. The insurer will have to set up an internet archive of the audited financial statements and disclosure statements over the past 5 years, Ms. Carmen. It says whichever is shorter. So we start from the first applicable financial year. Let's take the financial year ending on the 31st of December 2025. So starting from August 31st, the first disclosure is due. This applies. That means disclosure has to cover at least 5 years. So does that mean 5 years later, the public will not see what's disclosed? What should we make of or here? A, it says all financial years from the first applicable financial year to the latest financial year or the latest 5 financial years, whichever is shorter. Can you explain this?
Well, 3.8 says that they will have to have at least 5 years records, but then as the law comes into effect recently, and therefore the first one will be the one from 2025, and then by 2031, then you will have at least 5 such disclosure returns and so on, and then they will have to have at least 5 such reports online, and then later on they will have at least 10 odd such reports, but then they will have to have at least 5 such reports because that's a minimum requirement under the law, and the insurer would also have to keep its own records. For example, if the public asks about the financial returns 10 years ago, then they would have to be able to provide that. So that's about the public's right to know. Thank you for your explanation, or else the public might think that they can only get 5 years records online, and then using your example, then after 2031, they don't have to disclose anymore. In fact, well, at least they will be able to date back to 5 years online. But then by 2040, the public will be able to get records of the past 5 years, but then they will still be able to ask the insurer for the report 7 or 8 years earlier on. So they will have to archive that. So the public can ask for a hard copy or a digital text or digital copy. Yes. Next, clause 4, financial statements to be disclosed annually. So that would be in accordance with the Insurance Submission of Statements, Reports and Information Rules, Cap 41 Sub-Legislation S, for each financial year within the reporting period. So they will have to submit such audited returns to the IA. So whatever they submit to the IA, that would also be the information that they will have to disclose every year. Clause 5. The authorized insurer, that doesn't include the applicable insurer, they will have to prepare a disclosure statement, and the details will be set out in 5.3. So, can you pause here? Yes, Mr. Lee? Yes, on 4, you talk about the financial statements that will have to be disclosed. I'd like to clarify about the application. So some of that has been set out in clause 2, so those will not be covered. But I'd like to find out if all others, including applicable insurers, their net asset value might be several $10 million. So are you adopting the same standards requiring them to disclose all the financial returns? Because for some insurers, they may not be working in the retail sector, so they are just engaging in some hotel business, and there might be some commercial terms incorporated in the financial returns, and they might be sensitive information. So can those sensitive parts in the financial returns be excluded so that they don't have to disclose it? Because that might involve commercial profits and pricing information, because they might be listed companies, and well, every year you will be able to look at their financial statements. But then for private companies, my understanding was that this law is a relatively new thing, requiring companies, whether by nature or by scale of operation, you're requiring them to disclose everything or every page of the audited financial accounts or statements. So can you explain a bit more? Yes, in simple terms, Chairman, well, the requirement applies to all applicable insurers, whatever the scale. But then Well, at certain junctures, if insurers think that there is certain sensitive information that should not be disclosed, they can make the application to the IA, but then they will have to have justifiable grounds for doing that. Yes, I understand that. I also agree that that would enable the public to have a better understanding of the insurers that are subject to regulation. It has to be as transparent as possible so that the public will be able to know exactly what their assets and liabilities are. But then if there is commercially sensitive information under the present law, there would be sufficient allowance for that. So I'm not suggesting that you should approve whatever they apply for, but then if there is sensitive information and if they are able to justify why that should not be disclosed, you're not saying that everything has to be disclosed. And of course, they will have to convince you in the first place, right? Thank you. Thank you. Okay, clause 5, bracket 3. Well, the authorized insurer must disclose a set of information, including 3A, the company profile, and also the corporate governance framework, and also the quantitative and qualitative information about its financial position. And then D is about qualitative information about its investments, and also E would be quantitative and qualitative information about its insurance liabilities, and F is about quantitative and qualitative information about its financial performance, and then G is about quantitative and qualitative information about its pricing adequacy for general business, and H quantitative and qualitative information about its capital adequacy, and then I would be qualitative information about its risk management. So that would be what the insurer would have to disclose. And then 5.4. And also J would be statement made by the controller. Yes, Ms. Carmen Khan. Yes, here you are assisting the public to understand the information to be disclosed. When we discussed the policy, you said that there would be a standalone template for the disclosure. So what's the relationship between this template and the information to be disclosed here? So is it that do you tell them how that should be integrated with the standalone template? Yes, there is a prescribed requirement that is under 3.2. There would be component parts to this table, and then if you connect it with 3.2, that would be in a standalone document to be disclosed, a standalone document in the form of a template using the format and standard disclosure templates. So certain information will be required in the templates. And then under 3.2b, so you talk about the disclosure template. That's the format and standard specified by the IA. So the disclosure template would also have to be connected with the insurer, and the insurer will have to disclose the information according to what is set out in the template. So it's recommended that in the future template, there should also be a guidance note, so you can help the public understand what is included in the table, right? Yes, we did mention that in our discussion on the policy last time. Yes, Chairman. So that's the end of the clause-by-clause examination. Okay, so on the public disclosure rules, any questions? If none, we have completed the clause-by-clause examination of the 3 pieces of subsidiary legislation today. Would like to ask the legal advisor. So in terms of the legal points and also the drafting style and text, any comment? Yes, earlier on we wrote to the administration raising some questions, but then on top of that, we don't have any issues that we have identified that might be problematic. So we have no further comment on this. Okay. We have completed the clause-by-clause examination of the 3 pieces of subsidiary legislation. Are we going to circulate the following papers for members' information? First is about the written comments from the public and also the government's consolidated replies and also the issues raised by the administration at the meeting and also their written response. So can we circulate those to members? So agreed. So after the circulation, depending on members' feedback, I'll decide if a further meeting is needed. So before this meeting, the Secretariat has not received any amendment proposals from the administration or from other members. So once again, I'd like to ask if members have intention to submit amendments. None. If indeed you like to do so, then you will have to make sure that you can submit it by the 22nd of June, that is next Monday, before 5 p.m. In accordance with the decision by the subcommittee last time, on the 24th of June, at the council meeting, I'll be moving the resolution so that the scrutiny period can be extended to the 15th of July 2026. And then on the 3rd of July, I'll be reporting the work of the subcommittee to the House Committee. And then on the 3 pieces of subsidiary legislation, if there are any amendments to be moved, then the deadline would be the deadline for notification would be 5 p.m. 8th of July 2026. AOB, if there is none. So as I said, if we need to have another meeting, then I'll be informing you in due course. Meeting is now adjourned. Thank you, administration team.